Okay, so now let's look at some key elements of trading in order for your trading or our trading to be halal. So first of all, we have to look at what you buy, and I've explained that. Um, well, I've explained briefly some of the things that are not permissible, like alcohol and pork. So pork trading is something. Pork belly futures. Pork futures are assets that are traded or securities that are traded on financial markets. So they're not permissible for Muslims because the underlying assets are not permissible. But a lot of things are permissible. So, and we also have to bear in mind how you buy it as well. So, what I mean by this is buying exposure to the asset versus buying the asset itself, and these are two different things. And this is going to be fundamental to understanding about forex trading. So, we've looked at rules for buying the asset. We've looked at regular sales, transactions, and how we need to be specific in the asset and the quality, the description, the units, the weight, the price, and how and when it's going to be paid for. So these are all basic rules of contracts of sale. And now let's talk about buying the exposure, because this is something that often happens in financial markets. So buying exposure. So how do you buy exposure? So let's say, for example, let's look at some shares of company X. Let's say the price is £100. And let's say you don't have £100, for example. Let's say you have £5. So literally, you cannot buy one share of the company. And this is an important point. This is why these products exist, right? Because people don't have the capital. So, but you want exposure to this. So let's say you think the share price is going to go from 100 to £105, but you don't have £100 to purchase the asset. So you can go to somebody and say, look, if the price goes to £105, then can you give me £5 in cash, right? And if the price does not go to £105, so if you're wrong, obviously for £105 or higher, then the buyer, you get £5. If it does not reach £105, this is a not equal sign, then the buyer gets nothing, but you have to pay £5, for example. So this is like a gamble. So your start off position is you have £5 capital, and if you're right, you're going to get extra £5, so you're going to have 10, and if you're wrong, you're going to end up with 0. Right? So you bought exposure to this product. Right? So what it means is you're getting some return based on the price movement. Right? Either you're right or you're wrong, and the price goes up or down, you're going to make money or lose money. So you've bought exposure, but you never bought the asset. You never bought it. And one of the reasons is because you only have £5 and it's worth 100. Right? So this means a couple of things. So what this is actually a derivative. So is this halal or not? I mean, this is quite a complicated question. So when we talk about derivatives, I mean, I don't want to go into that topic on detail because it is quite complicated. But some of the common types of derivatives that we will discuss. I'll just refer to some of them, but one or two I will discuss. The first is contract for difference. I'll discuss in detail. This is a derivative. But you also get futures. You get options. And you get swaps. So these are quite common in the financial markets, right? And I'll explain that shortly. Options are relatively common. So, I have people ask me, is option trading, is it halal? And the basic answer is no. Most scholars would say it's not halal, and I would tend to agree with them, just purely because you're not buying any underlying assets. But this video is not about explaining these derivatives and swaps. Are they halal? Again, I would probably say no, right? I mean, that's the answer most scholars would give. But then, when you understand in the banking markets, right, especially Islamic banking markets, they do billions and billions of dollars of swaps, right? And they're called profit rate swaps, PRS. So for them it's halal, for us it's not. So you can go figure that out and make sense of that. Okay, so now let's look at some examples of things that we can buy in the financial markets. So equities is quite a simple asset that we can buy. So in order to ensure that we remain Sharia compliant, we have to look at screening of equities. let me just explain very briefly what this means. I mean, this is, as with all the things that I'm mentioning, this is a very quite a complicated product. So by screening, yeah, that's a screening. So, you know, excuse my handwriting. So there's a couple of levels of screening. So one is the main activity of the company. So this should be, you know, Sharia compliant. It should be halal or it should not be haram. So if it's, you know, again, you know, involved in the main things that are not halal, if it's alcohol or gambling, or if it's involved with riba, you know, if these are its main activities, then it's not going to be Sharia compliant. And then we have rules about if it's not its main activity, you can have, you know, permissible amounts up to 5%, but then you have to cleanse your dividend and all that thing. But in general, the main activity should be Sharia compliant. And then you have second level of screening, which are the financial ratios. So they look at the balance sheet of, and the profit and loss. They look at the financial statements of the company, and they have 1, 2, 3, or 4, and they have to be within certain parameters. And if they are, then you can say the company is halal. So you need to go through these 2 steps of screening by the activity and the ratios. And once they are passed, then you can say the actual stock itself is halal or not. And these are services provided by certain companies. These are often professional services. I mean, some may be free, but 1 or 2 that I knew had been free are no longer free. And there are many different providers of these in the market. So this is something you need to do if you want to, you know, if you're concerned about Sharia compliance and you want to buy equities, you have to gain access to some information provider or data provider that does this screening and lets you know whether a particular equity is halal or not. Buying gold. So is this halal or not? And obviously, you know, the main answer is yes, because it's just an asset with a value. But you need to buy it a certain way. So if you're paying for it, then you have to pay for it at spot or hand to hand immediately. And you should be actually buying gold, right? This is an important point. You should be buying the gold. The reason I say it's important is because in modern financial markets, you're often not buying gold. Often it's gold futures that are being traded, and sometimes options. Right? And if you look at gold on, if you have a broker, right, and you a retail broker or a Forex broker, and they have a price on gold, you have to ask them what they mean. I mean, if it's the price of gold in US dollars, XAU, USD, these are the trading symbols. This is the price of gold in US dollars. In, you know, right now it's about $1,800 per ounce. And when this is quoted, often, you know, and if you take a position, if you buy this, you have to ask yourself, are you actually buying gold? I mean, very often the answer is no. You're not buying gold, you're just buying a position. You're buying an exposure that I mentioned earlier, and this is a derivative. So this is often what you're doing. So you have to ask your broker, if you want to buy gold, you have to buy it through somebody, through a platform. And when you do that, ask that platform provider, ask that broker, what am I buying? He will often tell you it's a derivative, it's often a CFD. And if you want to go to an exchange, like, in UK, we have the London Metal Exchange, we have the Chicago Metal Exchange, there's a couple of, like, Chicago Board of Trade. There's some other exchanges where commodities are traded on gold, and often it's futures and options. You don't get to buy gold directly, right? So be careful what you're buying. I say buying gold is fine, but make sure you're buying gold. So you often have to go to a company that actually sells gold, and then you have to talk about storage. I mean, there might be in a vault. You have to talk about bullion, gold bullion. Where's it located? Or if they're selling gold, again, they might sell you certificates that are based on gold. The price is based on gold, but there might be no gold underlying it, and you have to be careful about those. Or you could buy companies that are involved in the mining of gold, right? But these are equities, so that's a different way to buying gold. So when you invest in gold, it's reasonably complicated, but here I'm talking about trading on platforms. And so far on the platform, you know, I have found there are some products that do invest in gold, but they're not often the gold price that you see, you know, on the charts where you buy and sell positions. Oil. Can we buy oil? So again, I mean, can we buy oil? Of course we can. Yeah, this is fine to buy oil, but you've got to look at how you're buying it, right? Because again, when you look at the markets and the exchanges, right? So oils are oil futures. There's 2 types of futures. You have Brent crude, and then you have, I think, West Texas Intermediate. This is like sweet. It's sweet because it's processed a little bit. This is crude. So often when we see futures, the futures price in the news, I think often it's this one, right? This is the one that went negative a couple of months ago. And with these are futures, right? These are not oil that you pay money and you take it now. This is going to be delivered in the future, right? And these are often once a month. And if you buy oil futures, then you have to take delivery, right? These were some of the reasons why the oil price went negative, because storage costs were prohibitive. If you take delivery, you have to find somewhere to store it, and these are delivered in a certain state. I'm trying to think. I don't know if it's Oklahoma, but it's or Carolina, maybe Oklahoma. But these futures were delivered in a particular state, in a particular location. So, if you bought futures, you have to receive the oil in that location. You need storage in that location, and storage was all bought out. So you had the risk of receiving oil but nowhere to store it. And this is why the price went negative. So with oil futures, you're actually taking delivery. And remember, so futures are derivatives, right? You're not buying the asset outright, right? So this is why the question of how you buy the asset is crucial. And if you're looking to buy oil, on your broker platform through a CFD, again, this is another derivative. You're not buying oil, right? You have to get real here. If you're actually buying oil, then the seller should be asking you, where do you want the oil delivered, or where are you storing it? If you're not answering any of these questions, then you're just buying exposure. Buying an index. So if you want exposure to an index like the S&P, the FTSE index, or the German or the French indices, or any sub-index to do with sub-index to do with an industry or a geography. If you're buying exposure to these, indices are not tangible assets, right? You don't buy an index and take delivery of it anywhere. It's just a number, right? Index is just a number, and it's going to go up or down, and you're taking a position on this. So the way you get exposure to this is through a derivative. There's no other way, because they're not even real. They're just numbers, right? So how do you get exposure to a number? Is through a derivative. Often it's through a CFD, but you can buy options. So if you have a broker platform and they're offering you positions on indices, then ask them what it is. Is it a CFD? And I'll explain what CFDs are, whether they're Sharia compliant or not. But an index it's nothing real. It's a derivative. Buying Bitcoin. Okay, I'm laughing here because it's a very complicated issue. But I'm not going to get into this issue whether it's halal or not. But potentially it's halal. Some scholars say it's halal to buy. Some scholars say it's not. Some scholars say it's halal as an asset to purchase into. Scholars say it's halal as a currency, or it's not halal as a currency. I have really no interest in those opinions. You take whatever opinion you want and you do whatever you like. But be careful if you're buying Bitcoin. The only thing I would say, be careful what you're buying. Are you buying the actual coin itself? And you're taking delivery of a coin? Do you own the coin? Can you withdraw the coin and spend it yourself? Or are you just buying an exposure to the coin? And if you're just buying an exposure, then it's like any exposure through a CFD, for example. And I'll talk a little bit about those later on in the series about CFDs. Okay, so now we can look at what is referred to as a contract for difference. This is often shortened to CFD. And this is it's a transaction. It's quite popular nowadays. It's used in many scenarios. And so let me just give an example. So it's a contract where you take a position. So this is assuming you're buying the CFD. So as a trader, you're buying the CFD, you're buying a position, and then you are paid out a return, potentially. Well, actually, you can make a loss as well, right? So you can make a profit or a loss. And the amount of profit or loss depends on a result, something that's happened, something that's going to happen. And this is based on Okay, so let's look at actual outcome. Okay, so there's an actual outcome, and what the contract does is when the outcome happens in the future, it compares the actual outcome to your position, and it looks at the difference between these two. And then this difference is what will result in either a profit, I put pi for profit back from our mathematics days, or a loss. Okay, so essentially you're placing money for, on an assumption, or you think something's going to happen a certain way. And if it does happen, you get paid something. If it happens against your view, then you can lose money. So this is often, so here we're talking about difference. So there has to be something that's numbers based, right? So the return is based on numbers, and then the actual outcome is based on numbers, and then we look at the difference. So let me give one example. So you can pick, for example, let me start a new sheet. So you can pick the number of days it's going to rain. I mean, in the UK, it rains quite often. So let's give the UK example. Let's pick the month of March. So you can say in March, so obviously you're going to take this position before March. So you have to take it in February, for example, before this event occurs, which is 1 month long. So you'll say that in March, I will take a position. I think it's going to rain for 10 days. So this is your position, 10 days. And then you have to place a stake or an amount, right? You have to decide how much you want to invest into the CFD. And you can say, for example, so the way that this can work is you can place an amount or a stake. So let's say, for example, the stake you place is £5 per day. Right, so what you think is so your assumption is going to rain more than 10. So you're bullish on this scenario, right? And so what happens is that then in March they will look at the actual result. How many actual days does it rain? So this obviously has to be from the 1st of April, and there'll be a number, right? So it could be 3 days, which is unusual for the UK. It could be 20 days. And so effectively, you look at the actual result compared to your position, and we look at the difference. So let's say it rains 3 days. Let's look at this result first. So here, compared to what you said, what you thought would happen, 10 days, it's rained 7 days less. So your difference is 7 compared to what you predicted. So how do you translate this now into money terms? Because that's the whole point of this. So you have to have an amount per day. And you decide this at the beginning, right? In February, when you place the trade, you say, my stake per day is, let's put £4 per day. That's your position, right? So you're 7 days short of what you thought, and you took a long position, so you're going to lose £28. Right? This is a loss for you. Let's look at the second outcome. Let's say it rained 20 days. You're bullish, you took a long position, and so it rained more than 10, so you're going to make a profit. This is 10 days plus 10, this is the difference. Remember, this is a contract for difference. And your stake is what you agreed before, £4 per day. So you multiply by 4, so you're going to make £40 profit. Right. So this is a very simple contract for difference. I mean, I gave this example because this is what was traded, and maybe it still is traded now. You can take positions on the weather. And so this is how it works. You take your base position, so you think it's going to rain for 10 days, and either you can take a long or a short position, but we've simplified it by looking at a long position. So if it rains for more than 10 days, you make a profit. For each day in excess, you make 5 days. If it rains for less than 10 days, for each day less than 10 days, you make a £5 loss. So this is how it works. So based on the actual difference between your position here and the actual outcome, multiplied by your stake per day here, this gives you either a profit or a loss. So this is a very, a brief example of a contract for difference. So let's look at now something called spread betting. Now, spread betting is actually very similar. I mean, I would go as far to say that spread betting is pretty much the same as a CFD. And the only differences you see sometimes is maybe on the tax position of your winnings or your losses, right? I'm not sure which way around, but maybe whether it's a CFD or spread betting with the odds firm, with a sports firm. I think the income, certainly in the UK and maybe the US, any income or loss you make on that is treated slightly differently for tax purposes, but otherwise they're essentially the same. Spread betting. I mean, spread betting is offered in sports. You can be in anything. So, I mean, I mentioned the weather. I mentioned about rain, right? So this is something that can be done. I mean, in sports. So, for example, I follow cricket a lot. So, I mean, if you're not British, you might not know what cricket is, but never mind. It's just a sport. So you can take a position on the winning margin, for example, which can be number of runs or number of wickets. Or, and this is where there's been some controversy in the last 1 or 2 decades. You could take more specific positions. And this relates to match fixing, right? This is quite a big thing in sport, especially in something like cricket. It's been a big problem. So rather than actually arranging to win or lose a match, because then you have betting syndicates that get involved in the outcome. They will bribe the players to win or lose matches. So, and this is sometimes quite easy to spot. All it takes is somebody to report it. So what they have done is they created scenarios which are not so easy to spot, not so easy to manipulate. So, for example, they would look at one particular over, which is 6 balls, and you can choose an over. Say you pick the 15th over in the match, and then you can take a position on how many wides, for example, would be in that over, how many no balls, and so on. So one of the major controversies we've had in cricket, especially the international teams, is that a certain number of no balls were bowled in certain overs, and they found that betting syndicates had taken large positions on the specific number of no balls, and often they find that the players were involved in some form of bribery. But this is spread betting on sports. So in tennis, which I enjoy as well, so you can bet on the result, but you can actually bet on the score. Right, so you can bet whether it's going to be 6-0, 6-2, and so on. And then when a game is going on, so now with technology, when the game is going on, you can do things live. So when you're in the middle of a game, you can bet who's going to win the next game, and I think you can probably bet who's going to win the next point. Right, so I mean, here I use the terminology bet because that's exactly what it is. So this is spread betting, and obviously it's very big in football. All kinds of betting is very big in football. So it occurs often in sports. This is called spread betting. But really, it's a contract for difference. These are the same, right? So mainly it's just a terminology.